Imagine a country striving to be a global technological superpower, yet running its entire financial engine on a rulebook written before humanity even landed on the moon. It's wild, right? Welcome to this explainer. Today, we're diving into the absolute biggest architectural redesign of India's economy, the Income Tax Bill 2025. We aren't just looking at a dry piece of legislation here. We're decoding how a nation is finally bridging the gap between traditional old-school taxation and the modern, lightning-fast digital economy.
All right, here's how we're going to map out this briefing. First up, the need for transformation. Second, we'll decode the 2025 framework itself. Third, we'll tackle the digital economy and markets. Fourth, we'll do a critical analysis of the real challenges. And finally, we'll wrap up by mastering the core concepts.
So, part one, the need for transformation. Why exactly are we rewriting the rules from the ground up?
Think about it for a second. How do you actually govern a 21st century digital economy using a rule book written all the way back in 1961? It's like trying to run modern smartphone apps on a rotary phone. Just imagine the sheer friction involved in managing today's dynamic, high-speed startup ecosystems under the outdated Income Tax Act of 1961. The old rules simply couldn't handle modern economic realities without creating immense legal complexity and endless interpretational disputes. A transformation wasn't just optional at this point, it was an absolute structural necessity.
And this visual brilliantly illustrates the solution. We are looking at a radical, massive reduction in legal weight. The government is replacing this dense, 823-page tangle of text with a modernized, streamlined 622-page pipeline. We're talking about literally halving the legal word count, dropping from a staggering 5.12 lakh words down to just 2.60 lakh words. This isn't just some light editing. It's stripping away decades of accumulated legal bloat to give us less complexity and a whole lot more clarity.
Now, this transformation is happening right now, on a very strict timeline. The bill was officially introduced in the Lok Sabha on February 13, 2025. Right now, it's undergoing a crucial parliamentary committee review, where they're likely going to make amendments to refine the laws. The final target for all of this? Scheduled implementation on April 1, 2026. So this gives stakeholders a clear, definable runway to adapt to the new reality.
Moving into part two, decoding the 2025 framework, or the actual architecture of this new law.
Okay, I want you to focus on this number right here, 57. It is a crucial piece of this new architecture, representing a massive jump from just 18 data tables in the old 1961 Act to over 57 tables in the new 2025 bill. Now, you might be wondering, why does a simple shift from paragraphs of text to data tables matter so much? Well, ambiguity is basically the lifeblood of litigation. By replacing walls of complex, confusing legal text with clear, structured data tables for things like tax slabs, deductions, and exemptions, the government is strategically minimizing that ambiguity. By making the rules visually clear and mathematically absolute, the goal is simple but powerful: drastically reduce those decades-long court battles.
We're also seeing a major shift towards simplified terminology. For decades, taxpayers have been totally confused by the dual concepts of assessment year and previous year. I mean, it was inherently confusing. The new framework abandons that old setup entirely in favor of a single, straightforward tax year. This modernization of definitions is specifically designed to avoid misinterpretation and honestly just make basic tax compliance significantly easier for the average citizen.
But here's a really vital piece of the puzzle. Amidst this massive structural overhaul, the bill introduces absolutely zero changes to existing tax rates. None. It doesn't introduce any new taxes either. The strategy here is stability. The government aims to modernize the procedural aspects without causing any sudden economic shocks or disruptions, leaving the actual tax rate modifications to the Annual Finance Act.
So how does this actually affect you? Well, taxpayer interaction is being totally re-engineered into a streamlined compliance pipeline. It starts with pre-filled tax returns that have far more detail to instantly reduce human error. From there, it moves into AI-driven, faceless assessments and appeals. This systematically removes physical, face-to-face interactions with tax authorities, which helps prevent corruption and delays. And all of this culminates in faster refunds through real-time processing. Plus, a new explicit taxpayer charter guarantees your rights and fair treatment through this entire automated journey.
Which brings us to part three, the digital economy and markets. Basically, taxing the virtual world. For a long time, the digital asset world operated a bit like a shadow economy, but the new bill officially tackles that. Virtual digital assets, or VDAs, meaning your cryptocurrencies, your NFTs, and other digital assets, are now formally recognized as capital assets.
This is huge because it means crypto transactions finally have a well-defined taxation structure. They're utilizing a GST-like compliance system designed specifically to track these digital transactions and, of course, avoid tax evasion. But it's not just crypto. This new framework ripples across several key economic sectors. Take startups, for example. We see a clear focus on easing their burden with relaxed compliance norms and tax exemptions for newly incorporated businesses. Over in the broader markets, there's a revised, much clearer classification separating short-term and long-term capital gains, making the rates far more transparent for investors. And notably, nonprofit organizations finally get their own dedicated, simplified framework, providing much-needed clarity to what has historically been a highly litigious and complex area to navigate.
Let's step back for a critical look in Part 4, Critical Analysis and Challenges. What are the friction points?
Now, this is where things get really interesting and maybe a bit concerning for some. One of the most expansive changes is the new definition of the virtual digital space. Under the 2025 bill, taxpayers who are under investigation must provide authorities access to their digital records. And we aren't just talking about basic bank statements here. It explicitly includes email servers, social media accounts, online investments, trading platforms, and even your cloud servers. This grants investigators truly unprecedented access to a taxpayer's entire digital life.
And that sweeping surveillance power leads us directly to a vital analytical question, right? Does modern tax enforcement have to come at the cost of individual digital privacy? The possible infringement on a citizen's digital footprint makes it incredibly clear that there is a pressing need for strict safeguards. We need clear guidelines to protect taxpayer rights from excessive state scrutiny. Looking at the full picture impartially, we've got a balance here. The bill achieves massive wins in procedural efficiency. It drastically reduces litigation, eases compliance through simplification, and boldly integrates the digital economy. However, it definitely faces valid challenges. Beyond the privacy risks we just discussed, there's still ambiguity around the exclusion of old regime slabs, which raises questions about its future. Furthermore, there is a distinct lack of major updates to the penalty enforcement mechanisms, aside from lower penalties for voluntary disclosure. Many experts see that as a missed opportunity to truly modernize how compliance is actually enforced.
Finally, Part 5, Master the Concept. Let's do a quick final revision to lock this all in.
I want you to lock these 5 high-yield takeaways into your memory. Number 1, the massive structural simplification, dropping the law down to 622 pages. 2, the unified tax year terminology, replacing those old, confusing timelines. 3, the full integration of AI-driven faceless assessments to ensure transparency. 4, the formal recognition and taxation of cryptos and NFTs as capital assets. And 5, the significantly expanded investigative access into the virtual digital space, which sits right at the center of the ongoing privacy debate.
So as we look toward that April 2026 rollout, and as the Parliamentary Committee continues its review, ask yourself this: will this modernized tax code ultimately empower the digital citizen through frictionless compliance, or will it fundamentally expand the surveillance capabilities of the state? It's a huge question, and the answer will define India's economic and civic landscape for decades to come. Thank you so much for joining me for this explainer.